name is Andrea. I'm the owner of Contractors Keeper LLC, where we provide bookkeeping and advisory services to contractors in the construction trades. Today, I'm going to do a brief presentation on financial statements. This is a very high-level overview just to help you understand what each financial statement includes. Now, these statements should all be part of your monthly reporting package. These statements are the income statement, the balance sheet, and your statement of cash flows. We're going to walk through what is included in each one and provide some examples. First, we have the income statement, which is often called the P&L or profit and loss. The income statement covers a date range. So you'll see that in this example, this covers January 1st through December 31st of 2024. Obviously, with your monthly reporting packages, then they would cover a period that is a month of time. So it might be December 1st through December 31st. Most often, income statements are run monthly, quarterly, or yearly. Most people are at least somewhat familiar with income statements. We're going to walk through the basic information that's normally included. So first we have income. This is your gross income. This is the money that you make from the services or products that you sell. In this case, this company has made $1 million in this time period. Then we have your cost of goods sold. This is often referred to as COGS for short. These are your direct job costs. So the accounts in COGS would normally be your materials, your subcontractors, your equipment rental. We also often try to include the commissions in here because they're normally based on a percentage of the job, so we view them as direct job costs. You might also include some employee labor in here for your employees that are field employees. Now, your income minus your COGS equals your gross profit. So in this case, this company had income of $1 million, cost of goods sold of $600,000, which leaves them a gross profit of $400,000. Below that will be your overhead expenses. These are things that keep your business running but are not related to a particular job. So these would be things like advertising, your admin payroll, office supplies, vehicle expenses, things like that. That all falls under overhead expenses. Also, any labor that is not directly related to a job would be recorded in the payroll associated with your overhead expenses. Below the overhead expenses would be other income and other expense items. These would be things that are not directly related to your primary operations. So, for example, you might receive interest from your savings or money market account. That would fall under other income. You might receive credit card rewards. That would also be under other income. And an expense that would often be recorded in this section would be something like depreciation. Now, your gross profit minus your overhead expenses plus other income minus other expenses, that equals your net profit. So in this case, our gross profit was at $400,000. We had overhead expenses of $250,000. To keep this example simple, we did not have other income and expenses. So the net profit was $150,000. With these numbers in mind, you can easily calculate your first KPIs, which would be your gross profit margin and your net profit margin. So gross profit margin is the gross profit divided by income. In this case, it's 40%. And your net profit margin is the net profit divided by income, which equals 15%. Next, we have the balance sheet. The balance sheet does not cover a range of time, rather it covers a specific date. So it's like a snapshot of where the balances are as of a certain date. In this case, we're doing it as of December 31st. The first part of the balance sheet covers the assets. So this would include what is called current assets and non-current assets. So your current assets would be things like your cash, your checking, your accounts receivable, inventory, things that in terms of liquidity would be easy to move. And then your non-current assets or fixed assets would be things that you kind of keep on hand for a while. They usually have a useful life of 12 months or longer. These would be things like your equipment, vehicles, and other property that you plan to use in your business. You'll see in our example, we also have right below equipment and vehicles, accumulated depreciation. And so this subtracts some value from that property, usually based on how much was taken in depreciation on your tax return. When we look at this example, we see that the cash on hand and the checking balance equal $100,000. We don't have any in accounts receivable in this example. We don't have any inventory in this example. We do have equipment and vehicles totaling $100,000, and we have taken $50,000 in depreciation. So when we add the 100,000 with the 100,000, we get 200, and then subtract the 50, and you wind up with total assets of $150,000. The next section on the balance sheet is the liabilities section. In this section, you will find your accounts payable, your credit card balances, and loan balances. This is also split between current and non-current, or short-term and long-term. So accounts payable is something you expect to pay relatively quickly. Credit cards you have to pay on monthly. So those would both fall under current liabilities. Now your loans, if they last longer than a year, then those would fall under long-term loans. In this example, we don't have any amount in accounts payable. We do have a credit card balance of $5,000, and we have a loan balance of $15,000. So when we add those two together, our total liabilities are $20,000. The last section is the equity section. Now, the equity section can be structured differently depending on the type of tax structure that the company has, but generally speaking, there may be stock involved and some kind of an account for contributions and some kind of an account for distributions. So for sole proprietors, for example, we wouldn't have stock, but we would have owner's contributions and owner's draws. For an S corporation, we would have the stock, and then we would have an additional paid-in capital account and a distributions account. So it just depends how the company is structured, but basically the owners are shareholders. Are they putting money in or are they taking money out? And that's what's recorded there. Then we have retained earnings, which is a cumulative amount of the money that has stayed in the company. Below that, we have the net income. This is an amount that is carried over from the income statement. If you recall, at the bottom of the income statement, it had the net income was $150,000, and so that amount has been carried over here. To kind of explain how the retained earnings work, this is as of December 31st, 2024. So when we roll into January 1st, 2025, most accounting software often makes an entry to move that net income amount into retained earnings. So as of January 1st, 2024, if we had not made any sales on January 1st, then the net income on here would be zero and the retained earnings would be $200,000, not including any journal entries that would be made to move equity amounts. One thing to remember about the balance sheet is that the total assets must equal the combined total liabilities and total equity. So our total liabilities here were $20,000 and our total equity was $130,000. Our total liabilities and equity are $150,000, which match the $150,000 of total assets. Last but not least, we have our statement of cash flows. The statement of cash flows also covers a date range. We need to know what money went in, what money went out during this time period. We'll see why this is important. So the statement of cash flows, there are a couple of different methods. This is the way that you will normally see it. We have the top section, which is operating activities. Very interesting. This also shows net income. So net income kind of carries across all of the statements. This one is a little bit less because I'm not covering the whole year in the statement of cash flows. I'm just covering 1 month. So let's say that for December 2024, the net income was $10,000. Now that net income is stated in accrual basis. We can cover that in a different lesson. But basically, a cash versus accrual is just a matter of timing of when you are recording income and expenses. But this net income of $10,000, $2,500 of it is from accounts receivable. So you have recorded income of $2,500 because you sent those invoices out, but you have not actually received any cash. So this gets backed out of net income. Now the accounts payable gets added back in because you recorded bills, which were accounted for on the income statement, but you did not actually use cash yet to pay those bills. So in this case, in this example, the $2,500 and the $2,500, cancel each other out. Usually it's not going to be exactly the same. And then credit card is on here. And this could be a positive, it could be a negative. Depending on, did you spend more on the card than what you paid on the card, or did you pay more on the card than what you spent on the card during this time period? So in this case, let's say we spent $5,000 on the credit card. Then it would be a positive number if we hadn't paid any of it back, because we recorded expenses that we haven't used any cash for yet. Let's say we hadn't purchased anything on the credit card, but we had paid back on the credit card $5,000. Then that would subtract from our cash because we used our cash to pay on the credit card. Now, in this particular case with the negative 1,000, then we paid 1,000 more than what we spent on the card in this particular time. So we take our net income of 10,000, subtract the 2,500 for accounts receivable, add the 2,500 for accounts payable, and subtract the 1,000 for the credit card, we wind up with total operating cash increase of $9,000. But there's still additional sections to consider. So our next section is for investing activities. So when you think about investments, you're spending cash for something that you hope will make you more money. In this case, we bought a used truck. We spent $10,000 on this truck. So that decreases our cash balance. Now here's where you can see where this information is very important, because the purchase of this used truck is not accounted for on the income statement. So that's why net profit does not equal net cash. There are additional things that cash is used for that is not cost of goods sold and not an operating expense. In this case, when we purchased this truck, the value of this used truck was added to our fixed asset account for vehicles, which is on the balance sheet. Below that, we have the financing activities. So for this particular used truck, we did spend $5,000 in cash, but $5,000 came from a loan. So we have a used truck loan, and that $5,000 added to our cash, which we used to pay the truck. Then let's say we had another loan that we made payments on, and the total of the principal portion of that payment was $500. Then this decreases our cash. And again, another example of something that you wouldn't see on the income statement. The interest portion of the payment is recorded on the income statement, but the principal portion just decreases the balance of those loans on the balance sheet. Then the last thing we have here is distributions. Again, you don't see this on the income statement. You just see this as a reduction in equity on the balance sheet. So the statement of cash flows helps us to see where the money went that was not accounted for on the income statement. To total our financing activities, that truck loan added $5,000 of cash. Our principal payment on the other loan decreased our cash by $500. Distribution decreased our cash by $5,000. When we subtract that $500 and $5,000 out, then we wind up with a negative $500. At the bottom, we see how these all net out. So we had $9,000 from operating, negative $10,000 from investing, and negative $500 from financing. Those total negative $1,500. So it shows us what our cash balance was at the beginning of this period, which was $101,500. With that net cash decrease of $1,500, then we have an ending cash balance of $100,000. So that was an overview of what is typically included in each one of these statements and how they relate to each other. In future videos, we'll dive deeper into some KPIs that can be drawn from these statements, ways that you can make decisions based on the information contained in them, and even plan ahead. If you found this information useful, please like and share this video. Please subscribe. On most platforms, our handle is Contractors Keeper LLC. And if you're looking for help with bookkeeping or advisory, please book a free call at contractorskeeperllc.com. Have a great day.